If you think gold and silver trading is only about charts and price movements, then you are missing the biggest part of the story. The real action happens inside the physical delivery system. Welcome to Gold Silver Scope, where we break down the truth behind gold and silver markets in simple language. In futures markets, traders can choose to close their contract, roll it forward, or stand for physical delivery. Standing for delivery means demanding real metal instead of paper settlement. Inside approved vault systems, metal is stored in two categories: eligible and registered. Eligible bars meet quality standards, but are not available for sale. They can be moved to the registered category when needed for contract settlement. Registered bars are the ones used to deliver against futures contracts. Many big vault facilities operate under this system. Large amounts of gold and silver sit inside these warehouses, but not all of it is available for immediate sale. When demand for physical metal increases, pressure builds on registered inventory. Sometimes metal moves from eligible to registered. Sometimes it leaves the vault completely. These movements tell us more about real demand than price charts ever can. Gold and silver are not just trading instruments. They are physical assets stored in vaults, moving between categories based on demand and supply pressure. In the current contract cycle, gold delivery numbers are unusually high. There are thousands of open contracts still demanding physical settlement, even close to expiry. With only a few days left before contract expiration, a large volume of gold ounces is still outstanding. That represents millions of ounces that must either be delivered, rolled over, or closed. When contracts remain open late in the cycle, it often means some traders are trapped. If they sold gold without securing physical supply, they now face limited liquidity. At this stage, buying back contracts can become expensive because most traders have already moved to later months. When markets become thin near expiry, price movement can become sharp. Short positions without metal backing create risk. If participants rush to cover, prices can react strongly. The key point is this: high outstanding contracts near expiration signal stress in the system. It suggests strong demand for physical gold at a time when available supply may be tightening. Gold stability depends on trust. If confidence weakens and participants fear shortages, leverage unwinds quickly. Silver behaves differently from gold. It is smaller in market size, but more explosive in movement. One silver contract equals 5,000 ounces. In recent months, millions of ounces have stood for delivery. However, something unusual happened. Vault withdrawals exceeded actual delivery numbers. More silver left the warehouse than was required to settle contracts. This means metal was pulled out from inventory beyond just delivery settlement. For example, over 23 million ounces were delivered, but more than 38 million ounces left the vault during the same period. That is a huge difference. When metal leaves by truck and moves into private or industrial hands, it rarely returns quickly. Such movement indicates strong physical demand outside the paper system. Silver stored inside vaults may be classified as eligible, meaning it is owned but not available for sale. When it moves out completely, it reduces total exchange inventory. If withdrawals continue at this scale, available supply tightens further. That creates pressure on future contracts and increases volatility. Silver is often called gold's smaller and faster cousin because when supply tightens, price reactions can be powerful. Many traders rely on charts, indicators, and momentum tools to judge whether gold or silver is overbought or oversold. But applying stock market style analysis to precious metals can be misleading. Gold and silver are not traditional investments like company shares. They are monetary assets and final settlement tools. They carry no counterparty risk. Unlike credit instruments that depend on repayment promises, physical metal does not rely on trust in a borrower. When global debt increases and governments expand spending, confidence in fiat currency weakens. In that environment, investors shift toward tangible assets as protection. Rising prices do not always mean speculation. Sometimes they reflect currency value decline or increased demand for monetary insurance. Open interest in silver currently does not show extreme speculative mania. That means price movement may be driven more by physical demand than retail speculation. The bigger picture is about credit versus real money. Credit depends on confidence. Gold and silver depend on physical possession. History shows that when credit systems face stress, real assets reprice strongly. Throughout history, currencies have collapsed when debt became unsustainable and confidence disappeared. Gold and silver have always acted as final settlement assets. They survive monetary failure because they do not depend on government promises. Today, governments face growing debt, fiscal pressure, and political challenges. Spending often increases because policy decisions aim to maintain stability through credit expansion. When debt growth becomes unproductive, pressure builds on currency systems. In that situation, physical metals often gain strategic importance. Recent large withdrawals from vaults and strong delivery demand suggest institutions and large players are positioning for uncertainty. Whether this leads to higher prices or structural reform depends on future policy decisions. But the trend toward physical accumulation is clear. This is Gold-Silver Scope. We break down gold and silver markets with facts, physical data, and deep analysis. If you want real updates on gold and silver, subscribe to Gold-Silver Scope and stay informed about what's really happening behind the scenes.